And the wildest part of this whole story is that it had almost nothing to do with Bitcoin itself. Bitcoin got slammed down to $78,600 overnight. That is roughly a 3% drop in a single trading session. $580 million in crypto positions got liquidated inside 24 hours. 95% of that was leveraged. Long bets getting their teeth kicked in. And the real cause is exactly what gold buyers have been talking about for the last year and a half. Inflation is back. The Fed is cornered. The bond market is screaming. And the entire 2026 trade just got flipped on its head in the span of 48 hours. So today is not really a story about Bitcoin's price tag. It is a story about the moment the macro music changed and gold sits dead center in everything that happens next. Welcome back to the channel. I am AI Ryan Matta. Real Ryan put this script together earlier this morning before he got buried in a stack of calls and meetings. So I am the one stepping in front of the camera to deliver it for him today. Wanted to flag that up front so you know exactly what you are watching. Today is Saturday, May 16th, 2026, and we are unpacking the Bitcoin slide that hit the wires overnight. Now, I know a lot of you are sitting on physical metals, stacking silver, holding gold, watching the macro picture, and waiting for confirmation. The exact forces that just hammered Bitcoin are the same forces that have been quietly setting up gold for what could be the trade of the decade. Inflation, the bond market, a brand new Fed chair, a global flight from risk. Stay with me. We are going through the data first, and then we are pulling back to what it all means for the metals in your portfolio. Let us start with the numbers, because they are big. Bitcoin opened Friday morning around $82,000. By the time Asian markets woke up Saturday, it had crashed all the way down to $78,600 before stabilizing back around $79,000. That is roughly a 4% drawdown from Thursday's high. $580 million in crypto positions got liquidated, and the breakdown there is what matters. 95% of those liquidations were on the long side, traders betting on higher prices, leverage, margin, all flushed out in one cascade. Bitcoin open interest, which is basically the total dollar value of futures contracts riding on the price, dropped from above $27 billion down to roughly $25.5 billion in a single day. That is a massive position cleanout. Bitcoin does this. Bitcoin has always done this. 20% shakeouts inside longer bull moves are normal. But the part that should grab your attention is what actually triggered the move, because the catalyst tells you what game is being played right now. On Wednesday, the United States Producer Price Index for April came in absolutely scorching hot. The number was up 1.4% month over month. Economists were expecting 0.5%, so the print came in nearly triple expectations. On an annualized basis, PPI rose 6% year over year. That is the highest annual producer price inflation reading since 2022. Let me put that in plain language. PPI is what businesses pay for raw materials, components, energy, and inputs. When PPI runs hot, those costs eventually push through into the prices you and I pay at the grocery store, at the gas pump, at the hardware store. PPI runs ahead of CPI. So a 6% PPI print is the market telling you that consumer inflation is not done. It is reloading. Combine that with the energy picture. Crude oil topped $100 this week. The Iran situation is still simmering. The Strait of Hormuz is a choke point for global oil shipping. Every time tensions flare in that region, oil gets bid, and oil getting bid feeds straight back into the inflation pipeline. So you have a producer price shock layered on top of an energy shock, layered on top of a bond market that is finally taking the hint. Here is where the story gets serious. For the entire first quarter of 2026, the market was pricing in 2 to 3 Federal Reserve interest rate cuts this year. The dominant trade was buy risk assets, ride the liquidity wave, watch Bitcoin push toward 100,000, watch tech stocks rip. That entire thesis just got torched. After Wednesday's inflation print, U.S. Treasury bond yields spiked. Bonds sold off hard across the curve. According to the Polymarket prediction markets, traders are now pricing in a 40% probability that the Fed actually raises rates again by the October meeting. Read that again carefully. Not a 40% chance of holding steady, a 40% chance of a hike. 6 months ago, that probability was essentially zero. The crypto market had been positioning for liquidity easing through 2026. It is now repricing the exact opposite scenario. The macro regime that everyone built their portfolios around just inverted in about 96 hours. Layered on top of all of that, the Federal Reserve just changed leadership. Jerome Powell's term as chair officially ended on May 15th. Yesterday, the Senate confirmed Kevin Warsh as the new chairman On May 13th, Warsh is now in the chair. And here is the part the market is digesting in real time. Warsh has already signaled that there will be no rate cut this year. There may even be a rate hike under his watch. He came into the role expected by some traders to be more dovish than Powell. He is turning out to look more hawkish. The bond market is treating his appointment as confirmation that the Fed has zero room to cut. That is a huge shift, and the timing is brutal. You do not want a Fed leadership change happening during an active inflation reacceleration. Markets hate transition uncertainty stacked on top of policy uncertainty. We are getting both at the exact same time. Let me give you another data point that tells you institutions are already moving their feet. On May 13th, the U.S. spot Bitcoin ETFs recorded a single day outflow of $635 million. That was the largest single day exit since January. For context, the spot Bitcoin ETF complex has been the structural buyer driving Bitcoin from 63,000 all the way up to 82,000 over the last 3 months. When that buyer hits the pause button or starts selling, the floor under the price goes soft fast. On top of that, corporate Bitcoin purchases have dropped 80%. 80%. So the two main institutional bid sources, the ETFs and the corporate treasuries, both pulled back at the same time. That is not a coincidence. That is institutional capital, reading the macro tape and deciding to wait. Now look at the equity damage from yesterday's session. Coinbase down almost 6%. Strategy, which is the largest corporate Bitcoin holder on the planet, down 5.4%. The Bitcoin miners got annihilated. Mara Holdings and Hut 8 each dropped around 7%. Cypher mining fell nearly 9%. BitDeer sank almost 11%. 11% in a single session. That is the kind of damage you only see when the macro thesis breaks underneath a sector. There is one more story breaking today that has to get flagged because it is not getting enough attention in mainstream coverage. The country of Bhutan, the small Himalayan nation, has been quietly one of the largest sovereign Bitcoin holders in the world. They mine Bitcoin using their abundant hydroelectric power. Blockchain analytics firm Arkham Intelligence tracked their wallets and found that Bhutan has moved and likely sold about $1 billion worth of Bitcoin since the middle of 2025. Their on-chain holdings went from roughly 13,000 Bitcoin all the way down to about 3,100 Bitcoin. Bhutan's sovereign wealth fund is publicly denying any sales. The CEO told CoinDesk via email that he does not recall the last time they sold any Bitcoin, but the on-chain data does not lie. The coins moved out to exchanges and trading firms. Arkham now estimates that at the current selling pace, Bhutan will have liquidated all of its remaining Bitcoin by October of this year. So there is a quiet, persistent stream of sovereign supply hitting the market. That is structural selling. It stacks on top of every other headwind we just walked through. Here is the part of the data that I find genuinely fascinating. Long-term holders, the wallets that have held Bitcoin for more than 6 months without moving it, have grown their stash by 300% since the end of 2025. They now hold close to 4 million Bitcoin between them. And they have started taking profits at a rate of about $180 million per day since Bitcoin rallied above 82,000. That sounds like a lot. In past cycles, it has been a much larger number relative to the move, so analysts are calling this controlled distribution rather than panic selling. The bigger problem is on the realized loss side of the equation. Daily realized losses are still averaging $479 million. In healthy market conditions, that number sits closer to 200 million. Until those daily losses compress back down toward the 200 million range, the on-chain recovery is not confirmed. So where does this leave Bitcoin technically? The first key support sits right around 78,000. If that level breaks on a sustained basis, the next zone of buyers is at 76,000. Below that, 75,000 is the major line in the sand for the bull case. On the upside, 82,000 is the critical resistance level. There is something traders are calling a gamma trap up there. Almost $2 billion in options positioning is clustered right around the 82,000 strike price. What that means in plain English is as Bitcoin tries to push back above that level, options market makers actually become forced sellers into the rally to hedge their books. That turns what looked like support on the way down into resistance on the way up. The other number that matters more than any chart level is the May monthly close. Famed analyst Tom Lee said earlier this month that if Bitcoin closes the month of May above $76,000, that confirms the bull market is officially back. Bitcoin has never closed 3 positive months in a row inside a bear market in its entire trading history. So that 76,000 monthly close is the single most important chart event of the year. We will get that print in roughly 2 weeks. Now let us pull all of this back and talk about why everything we just covered matters way more for gold than it does for Bitcoin. Because if you have been holding physical metal, watching this macro story slowly develop over the last 2 years, this is the setup. Gold has spent the last 18 months grinding higher quietly while almost everyone was focused on Bitcoin and tech stocks. The gold story has always been built on three legs: currency debasement, real interest rates, and geopolitical risk. All three of those forces just got their biggest single week of confirmation in 2026. Inflation running at 6% at the producer level means real returns on cash and on bonds are getting worse, not better. Cash is losing purchasing power every single day right now. A Fed chair who cannot cut rates without reigniting inflation is a Fed chair who is structurally trapped, oil sitting above $100, and an Iran situation that refuses to resolve, keeps the energy premium feeding into every price in the economy. Sovereign nations like Bhutan are quietly liquidating their digital reserves, while central banks around the world are quietly building physical gold reserves at the fastest pace in modern recorded history. China, Russia, Turkey, India, all of them buying gold by the ton. The framing here matters. Bitcoin was supposed to be digital gold. Maybe over a 20-year time horizon, it eventually becomes that. But when the macro hammer comes down hard, Bitcoin trades like a leveraged tech stock. It correlates with the NASDAQ, it correlates with risk, it gets sold violently when leverage gets flushed out of the system. Gold does not do that. Gold sits there. Gold has no counterparty risk. Gold has no liquidation cascade. Gold has been the asset of last resort for 5,000 years for a very specific reason. The institutional capital that is pulling back from Bitcoin right now is not going to park in cash forever. It is going to look for somewhere to deploy. And historically, when the Fed gets cornered like this, when inflation is sticky, when the dollar is under pressure, when geopolitical risk is elevated, gold is where that capital ends up flowing. We could be sitting on the front edge of exactly that rotation right now. There is a long-term setup that I want you to hold in your head. ARK Invest, which is one of the most bullish institutional Bitcoin shops on the planet, is forecasting Bitcoin reaches a $16 trillion market cap by 2030. That implies a price of more than $730,000 per coin. They argue that Bitcoin captures 40% of gold's total market value over that time frame. That is the bull case. But that thesis only works if Bitcoin proves itself as digital gold during macro shocks. And today's tape shows it is still very much in the proving phase. Gold holders are not in the proving phase. Gold is the reference asset. Bitcoin is trying to catch up to it. So whether you stack physical metal, whether you hold paper gold through an ETF, whether you mine, this is the macro setup you have been waiting for. Bitcoin holders are getting a hard lesson in what risk asset actually means in 2026. Gold holders are getting confirmation of the thesis they have held for years. All right, that is the report for today, Saturday, May 16th, 2026. If you got value out of this breakdown, smash the subscribe button right now. We do this every single trading day, walking through what is actually happening in the macro picture and what it means for your portfolio in plain English. Subscribing is free, takes 1 second, and it tells YouTube to keep pushing this kind of content out to people who actually need it. Second thing before you go, head over to bitcoinmaxing.com. That is bitcoinmaxing.com. Real Ryan built a free Bitcoin retirement calculator over there that runs the actual numbers on different accumulation strategies, different price scenarios, and different time horizons. It is genuinely useful whether you are stacking Bitcoin, holding gold, or just trying to model what your overall allocations might look like at retirement. Completely free to use. Link is right in the description below. I am AI Ryan Matta. Real Ryan will catch you in the comments. Stay sharp out there.